Hopefully I can turn off the transcriber. There we are. All right. It is 12:02 and this program is now being recorded. Welcome to Free Trade Agreements 201, a program of the U.S. Department of Commerce and the Indiana District Export Council. I'm going to turn it over to our Indiana District Export Council representative today, Christine, to introduce our speaker. We're excited for all that are joining this program today. Christine.
Thanks so much, Mark. So as Mark said, my name is Christine Everett. I'm with the IU Center for International Business Education and Research, or IU Cyber for short. We are one of 16 centers funded by the U.S. Department of Education with the purpose of supporting U.S. business competitiveness in the global marketplace. I'm also honored to serve as a member of the Indiana District Export Council. The Indiana DEC, for short, is a not-for-profit organization operating under the auspices of the U.S. Department of Commerce to promote and support exporting as a way to strengthen Indiana's economy, grow the state's economy, and create jobs. Strengthen Indiana companies and grow the economy. We offer one-on-one export counseling workshops, in-person events, and webinars such as this, and serve as a focal point of export information and resources for companies across Indiana. Each state has an export council, and please visit our website if you haven't already at indianadec.org. Thank you, as always, to our collaborative partners, the U.S. Department of Commerce, the Small Business Administration, Ex-Im Bank, IU Cyber, Indiana SBDC, the Indiana Chamber, and the International Center. These Export Lunch and Learn webinars are offered free of charge every month beginning with January. Today, we are also joined by additional DEC members, Lloyd Porter from Cook Medical Group, Toby Malachi from Malachi Group Worldwide, Mark Hubbs from Amtrol, Bruce Sherman from the Indiana Department of Agriculture, and Andrew Reinke from Foreign Targets International. And it is now my pleasure to introduce today's speaker, Susan Whitney. Susan is the Regional Director of the Great Lakes Network of the U.S. Department of Commerce. You all received Sue's bio in the emails that were sent out, so I'm going to turn this over directly to her so she can dive into all the good stuff this afternoon.
Christine, thank you. And I just want to thank the Indiana DEC for putting this event on. And with that said, we are going to dive right into this presentation because we have to cover 14 trade agreements with 20 countries in an hour. So my hope is that once we get through this presentation, we will have either an opportunity to look through some examples or we can open it up to Q&As. So let's get to it. So why do we have free trade agreements, right? What are the benefits? So the first benefit is obviously this is the one everyone knows. You have a tariff reduction, right? So your buyer in a foreign country can bring in your exported good at a lower rate, right? So that's number one. The second one is you have better protection on intellectual property. You can bid on government procurement with that foreign government, right? Fair treatment for U.S. investors. And the last one, and I think this is almost as important as a reduction in tariff, is product standard development. So we want our trading partners to take U.S. standards and adopt U.S. standards instead of CE marks or China standards. Okay, so as I said, we've got the United States has 14 free trade agreements with 20 countries. And here's the map of these free trade of the world of where our free trade agreements are. And we are not going to go through them individually. We're going through them as the type of free trade agreement. So how does your company get a reduced duty, right? So first, you have to make sure your product qualifies for the preference under the FTA rules, and then you have to let your customers know about it. So what does qualifying mean, right? So just because your product is shipped from, assembled in the United States doesn't mean it qualifies. So you need a rule and you have to have a value-added content for the goods to qualify for one of our free trade agreements. And, I've had companies many times, I've talked to clients who are like, oh, this is so much work. Why do we have to do this? Well, you have to qualify because if you didn't, companies would just probably transship their goods through one of our trading partners or through the United States to get the lower duty. And why does it matter? Why do you have to qualify? Why do you have to do all the paperwork? Well, once you say that your goods qualify for a free trade agreement and you get a preferential duty, which means that you are paying that foreign customs lower amount of money, you can be audited by that foreign government. So you have to actually do the work, and then you have to keep all the documents and all the preparation you did, because if you do get audited, you want to be able to supply that information. So if you look, once you get through this, now I hope this isn't the case, but once you get through this, if you say, well, that is a lot of work, I don't think I'm going to do that. You can still ship, you can still export, obviously, to our free trade agreement partners. Your company's not going to get the preferential duty rates. So I guess the first part we're going to look at is, how do you find out what your preferential duty rate for these 14 free trade agreements with 20 countries? So I have listed out these websites. Mark will either, I think, provide this on the DEC website, the Indiana DEC website, or we'll email this information to you, but don't have to worry about it. You will have all the links that are included in this PowerPoint. So the first one, the FTA tariff tool, that is actually ours, and that is just our free trade agreements. That's actually our website. The second one is the customs info database. And then the third one is the rules of origin facilitator. And I linked this one because this is just not the USA free trade agreements. This is, I think it's 350 free trade agreements with 190 countries. So I listed all three just so you have access to them. Okay, so the first thing I do with any client when they say, hey, I want to look into whether we should qualify, our goods should qualify for FTAs to get the lower duty, the first thing I do is, let's look at it. Let's make a business decision. Let's make sure it makes sense for your company to do so. So if you look at this chart, I've got the FTA rate, and then I had the non-FTA rate, and then the sales volume and savings. And I usually tell companies, do this list to see if this makes sense for your company to do the work. So to give an example, if you were exporting to Bahrain, the non-NAFTA rate, or non-FTA rate is 5%. But your sales volume is only 10,000. So we're saving $500. Is it worth it? Is Bahrain market growing? Right? So I don't know, $500 doesn't seem a lot to be able to hold your company up to a potential audit. The second one is Israel. I cannot tell you how many times clients have called me, and when I've looked at the FTA rate and the non-FTA rate, usually this is with Canada and Mexico, the non-FTA rate is already 0. You can't get better than 0. So there's absolutely no reason to do the work. The last one that I've highlighted is Morocco. So the difference is 2.5%, and they're shipping, 100,000. Is $2,500 worth? The other thing that you have to look at is you also have to look at if your competitors are using FTAs. So are you losing sales because you're making importers pay that extra duty? So what do you need to establish the proof of origin, right? So first you have to understand what the rules of origin is, and you have to understand what your HS classification, we'll get into that. So I'm assuming everyone on this phone knows what the harmonized system is, but that is your commodity classification that pretty much the whole world use. So it's what duties are, you need your HS classification to determine what your duty is, right? But HS classifications are also used for rules of origin. So you absolutely need to know your HS classification. So you also need your bill of materials. So what do you buy to make your product? Where does it come from? What is the custom valuation of the product? The value of the materials, and you need information from your supply chain. And then I think the last two is pretty important too. You need patience and time. Okay, so I mentioned HS classification. It's really important to have your correct HS classification. So when I say your good is being exported, when I say good, I'm saying that the good that you're trying to get the FTA preference. When I say material is what makes the good. So that would be a part of your bill of materials, okay? You need to know the HS classifications on both of those. All right, so I just want to say that if you're not sure of your HS classifications or you're not sure they are correct, please contact the Indiana office, my colleagues in Indiana, and have them help you make sure that your HS classifications are correct. If they are not, that means your rules of origin is not correct, which then means your supporting documentation is not correct. So I will give you an example. I had a client that had a classification that was based on use. So it had a domestic use and a restaurant use, two different HS classifications based on that. And their distributor was a distributor, I'm not sure of which one, I think it was for the restaurant. But because every customer or every household wanted to have this product, they started buying from the distributor that was only supposed to be selling within the restaurant industry. So what happened is, and this was against Korea Customs came in and said, all these customers that are for households, you have the wrong age classification, therefore, you do not comply with the rules of origin because you're using the wrong rules of origin. And it was $1 million difference, okay, with when the course came on. And so obviously when the client called me, they were a little upset because they were asked to write a check for $1 million. What we ended up doing is we were able to show that even if they changed the classification, that the goods still complied. So they were able to get a refund. But obviously HS classifications are really important, extremely important in this process. All right, so I just went through that. The other thing too is that you have to have your management buy-in to because it takes some work to qualify your goods. So then we're going to go over some basic concepts, and we'll go right into them. So origin versus originating. So a lot of times part of your document requirements, and this is for non-FTA countries, they'll ask for a certificate of origin, right? That is not the same thing as when someone asks you is your product originating according to an FTA agreement. So what origin mean is where the product was made, right? So in generally where the product becomes what it is. Okay, so a generic certificate of origin is different than when you're doing an FTA qualification. So originating means you must provide the value added production as per the FTA agreement. And once again, just because a product was assembled does not mean it qualifies for an FTA. Now I'm going to kind of just mention labeling. And labeling is really not part of an FTA agreement, but I just want to make sure you understand the difference. So every country, the United States and foreign countries, have labeling requirements, okay? However, the Federal Trade Commission in the United States has a Made in USA labeling requirement. This is not the same as when you export products to a foreign country. So the Federal Trade Commission, Made in USA, has a really high standard. It's basically that all or virtually all of the whole product is made in the United States. So what this means is that I've had clients that have to separate their labeling depending on whether they're selling in the US market or if they're selling to a foreign country. And as I said, foreign countries have their own labeling requirements. And once again, if you guys need more information about this, please contact the Indiana office. But I did put a link there on the Federal Trade Commission. There's guidelines on what it means to be made in the United States according to US rules. All right, so we'll get back to free trade agreements, but I just wanted to bring that up. Okay, so the next thing we need to talk about is customs valuation. And the why I put this in this presentation at this point is because, once again, just like HS classification, you have to understand customs valuation. If you don't understand it, and if your product uses a regional value content rule, and if you don't understand how custom valuation works, once again, your calculation will be incorrect. So there is the World Trade Organization has a way how to do customs valuation, and we're going to kind of go into this a little bit. This customs valuation, let me say, could be a whole day. All right, so I'm going to just talk about the normal or the what most people use for custom valuation, but once again, it's really important because it's how you apply the tariff. So most of your FTAs, you'll be relying on transactional value, or it's called adjusted value. And this is the price actually paid or payable for the imported merchandise. So it is the total payment that the buyer makes to an unrelated seller, right? So unrelated is a big deal, and it excludes international freight, insurance, and other CIF charges. So what is the total payment? So total payment, and once again, this is just to make sure that you're using the right numbers when we get to the calculation point of view, the calculation point of this presentation. But total payment will include the packing costs incurred by the buyer. So I highlighted buyer because if it's incurred by the seller, then it's fine. It's probably already included in the price. Okay. So when I think of packing costs incurred by a buyer, like, well, how could that happen? Well, let's say your shipping terms are Ex Works at your dock. Okay. That means the buyer might pick it up. They might have a freight forwarder pick it up from the dock, and then they may pack it. They may have the forwarder pay for the packing. So that would be something that you'd have to include. All right. So I just wanted to show that to make sure you're aware of it. Now, let's just say that you were selling to your importer was a related party. Well, then you couldn't use transactional value, and you would have to go to an appraised value. And as you can see, it starts off with transactional value, right? But if you're selling to a related customer, then you might have to use a transaction value of identical merchandise, similar merchandise, and then there's these other valuations, of which, like I said, I'm not going to get into just because it's a pretty lengthy discussion. But that being said, I wanted to give you references, okay, in case you cannot use transactional value. Most clients use transactional value, but just in case you can, I wanted to give you websites where you could go to find out how to come up with the other price values for
Hey,
your
Sue,
qualification. Yep.
Real
Go ahead,
quickly, I
Mark.
just want to make sure people have this. Can you explain one more time the difference between transactional value and total value? Because that's a pretty big deal. I just want to make sure people understand.
So transactional value, we call it transactional value, but we just want to make sure that you're using the right number, right? So in transactional value, that means the total payment includes the following. So you have to make sure, and it could already, like you might not have any of these circumstances. So it just may be what the exporter is selling at the price they're selling to their importer. But if it doesn't have these incurred costs by the buyer, then it has to be added in. Does that help, Mark? Is that what you're looking for?
Yes, I just want to, because I got a little fuzzy there, total value, transaction value, but the transaction or adjusted value is typically just the price you're selling to the buyer.
Right, unless it does include packing costs or selling commission incurred by the buyer, right? And if it doesn't include these, then you have to include it to make sure you're doing the calculations correctly. And a lot of people, when we do these presentations, we don't go into it but I just wanted to share, just in case we have that company that is selling an Ex Works and that foreign buyer pays a forwarder to do the packing. All right. And so here, as I said, these are website links. If you want to get into more of the valuation in case you have any of those circumstances, I just want to give the website link so you could do so. All right, so now we're going to look at some other terms that you have to understand before we get into the actual free trade agreements. And the one term is substantial transformation, or sometimes it's called tariff ship rule. And what this is that, when you're dealing with a non-FTA material, so material is what makes up the good that's being exported, that's being qualified, it becomes a different product, right? And my best example that I can show you that I've always used over the years is, let's say you're buying, let's say you're trying to get a qualify for USMCA free trade agreement, right? And let's say you're making bread. So your good that you're exporting to Canada is going to be bread, but you buy flour from Germany, okay? So when you bring in the flour, you substantially transform it so it becomes bread. So even though bread, 95% of bread is made of flour, it is still substantially transformed, which means, so a lot of companies make the mistake that it's all based on content, right? Well, in this case, it was based on content. It wouldn't qualify because the flower would be coming from Germany, which is not a partner of the USMCA Free Trade Agreement. But what we say is because you substantially transform that product into something new, that means you did so much work, there was such a production operation in the United States that it then qualifies for it to become a US product. So what this doesn't allow is for simple combining or packaging or, mere dilution of a product with water, right? You're just adding water. I had a client that was exporting to Canada, and it was a really funny call. The person calls me and they got a letter, which they didn't realize was an audit letter from Canada Customs saying, you need to prove that your products actually qualify for this free trade agreement. And he called me, he's like, I have no idea what this means. And I'm like, all right, well, just tell me what you're doing. He's like, well, I buy fabric from Japan, and then I think there's some kind of label or something or some kind of imprint of the fabric in Japan, and then we bring it into the United States and we cut it to shape. And I'm like, so you're saying that the only thing you're doing to this fabric is that you're cutting it? And he's like, yep. I'm like, okay. So I looked at the rule, and of course, it didn't substantially transform because all they were doing was cutting it in the United States, right? The duty differential was like 12%, and he'd been selling like $1 million to Canada for every year. So if they go back 5 years, we were talking, it was like 250,000 every year. And that's just the duty differential and not the penalty. Yeah, it was a pretty scary thing. I told him to politely call Canada Customs and ask for an extension. And then we had a consultant in the Cleveland area come in and work with this company. And they were able to reduce it to just the duty differential for the last 5 years, which was still very significant, but they did not get hit with the penalty because they were pretty compliant once they understood what was going on. So once again, that just to give you an idea of what substantial transformation and tariff ship rules mean, it's pretty important as far as free trade agreements go. Okay, so now we're going to look at the rules of origin, and how we're doing this is, like I said, we're not going to go through each one of these trade agreements, but we're going to go through the types. So in the green side that you can see, these rules of origin are mostly based on tariff shifts and regional value content. And then on the right side, the blue and orange are based on appraised value. All right, so once again, I always like to give websites, right? So if you're looking for rules of origin to find out what your product qualifies under, you can go to the International Trade Commission, and this really is probably the best one because they keep it updated. You can also go to the USTR. That is the USTR is the only U.S. agency that can negotiate free trade agreements on behalf of the U.S. government, but theirs is based on what the agreement was original, so it's not up to date. And the ITC, the reason why it's up to date is because there's changes in HS classifications every year, and so that obviously affects the rules of origin. So the ITC keeps up with that. And then the last one is the rule origin facilitator that the International Trade Commission does. And once again, that is just not U.S. free trade agreement. That has a lot of other free trade agreements. Okay, so now we're going to get into rules of origin, and these are the types of rules that you can have, and we'll go into each one. So first, wholly of. To be honest, I've never had a client that had a wholly of. But that is product must be produced in the territory, and all materials must be traced to the earth. So we're looking at minerals, fish, agricultural goods, right? And all the U.S. free trade agreements, all of them. So even all 14 free trade agreements have this rule. Okay, so now goods produced exclusively from originating materials. This one always confused me. So the best way I can explain this one is through an example. So let's say you are exporting a bamboo longboard, okay? And the bamboo wood comes from a country outside the FTA parties. But it is substantially transformed, right? So it was made into a new product. So it was made into a skateboard frame, making the frame originating material. All right. So if the skateboard manufacturer uses this bamboo wood frame and no other non-originating materials, the skateboard would qualify based on this provision. Okay. So let's now look at why it wouldn't qualify. So let's exact same thing. So the scenario is that they're taking this bamboo wood, they're substantially transforming it, making it into a skateboard frame, right? But then they're buying wheels outside of the FTA parties. Therefore, the skateboard would no longer qualify under this provision of from originating materials because the wheels are not originating, and they'd have to qualify under another rule of origin. So all the FTAs except Israel, Jordan, Morocco, Bahrain, and Oman have this provision. All right. So then the 35% appraised value methods. So these were the countries. This was Israel, Jordan, Bahrain, Morocco, and Oman. Okay. So now what I've done is I've grouped these into two different sets because Israel and Jordan have very similar language. And then the last three have very similar language. So once again, you always have, like I said, the wholly of. Okay. And if you can't use the wholly of, then the second one, and once again, here's that term substantially transformed, right? It's a new and different article, okay? And it's imported directly. That's a big thing, that direct shipment. It's got to come from the United States to Israel, Israel to the United States to qualify. And then it's the sum of the cost of value of materials produced in the exporting party. So if we were exporting to Israel, it would have to be the cost of the value of U.S. goods exporting to Israel, and also the direct cost of processing, and then it has to be not less than 35%. What makes this different than the other three is that it's this 35% that you have to get with the cost of value and the direct cost of processing has to come from the exporting party, okay? And then they also allow, they give you a cost of value of originating materials of the article from the other party of up to 15%. Okay. And once again, I want to stress that you're seeing these terms appraised value, right? And that is why it's so important that you understand what the appraised value is and make sure you calculate that right. Because if you don't understand that and you're not using the right number, then this calculation could potentially be incorrect. All right. So for Israel and Jordan, it is 35% cost of value of materials and direct costs from the exporting party. All right. Now, here's where the difference is. So for Bahrain, Morocco, and Oman, it is the same thing wholly of, and then also substantial transformation, right? But instead, the 35% can include one or both of the parties. So that means the 35% can include the value of materials from US and Bahrain, and then also the direct costs from both of those parties. So a little different, and you just have to be aware of it. But once again, these require a tariff shift provision. Oh, I'm sorry. Once again, these three have a few tariff shift provisions, very few, but you should be aware. So you still have to, if you're exporting to Bahrain, Morocco, and Oman, you still have to go to the International Trade Commission, or one of those three websites, and see if there's a tariff provision for your HS classification of the good that you're exporting to these three countries. All right. So the value of materials. So once again, I just want to make sure that everyone is aware of what is included, the value of the materials, and the language in all these five trade agreements are very similar. You might want to just look to make sure, but I looked at cross-referenced them, and they're very similar. So it's the manufacturer's actual cost of materials. And then when not included in the manufacturer's actual cost of materials, the freight, insurance, packing, other costs incurred in transporting the materials to the manufacturer's plant. So that means, let's say you're buying supplies from another company in the United States, it would also be the transportation of getting it to that manufacturing plant. The actual cost of waste or spoilage, material list, less the value of receivable scrap, and then taxes and duties imposed on the materials by a party, provided they're not remitted upon exportation. Okay. So once again, going into depth, but I always want people to understand what makes up a value of materials. So direct cost of processing operations. So all actual labor costs, right? Dyes, molds, tooling, and depreciation on machinery and equipment. Research, development, design, engineering, blueprint cost, and cost of inspecting and testing. So that all can be part of direct cost of processing operations.
Sue, just to make that simpler for people a little bit, we're saying that you're using these methodologies so that they can apply to the trade agreement so that you can comply with it and receive preferential treatment, just so people are,
Right.
just so,
So
that
for
people
these
are understanding.
five, yep. So these five, the Israel, Jordan, Bahrain, Morocco, and Oman, they don't have rules of origin like the tariff shifts. So what they do is they use the appraised value method, the 35% appraised value method. And you know what I'll do, let me see. Let's see, I'm gonna, you know what, I'm just gonna go back just so you can kind of see why I'm doing that. Let's see where that slide was. Sorry, guys, let me just, because I think, Mark, if I'm losing people, I just want to make sure people understand. Okay, so this slide I think helps. So the 35% appraised value method for rules of origin is here, these 5 countries, and that's what I'm talking about. So these countries, these 5 countries use the 35% appraised value. Israel and Jordan are just doing 35% value of the exporting country of the value materials and processing, while Morocco, Bahrain, Oman allow both parties to get to that 35%. Does that help, Mark?
Yes, it does. I think this is the coolest slide because it tells people on this call today, most of the time you're going to use the tariff shift or regional value content method to comply with the agreement. But in these other cases, you've got these other countries use this 35% of appraised value. If you, as long as you know what that appraised value is and you hit the threshold, then you can comply with the agreement, correct?
That's absolutely correct. And that's why I have this slide. And that's why I'm going to, you know, like I said, I'm covering 14 free trade agreements, but I'm only talking about 5 or 6 different rules of origin that get you there. And so for these 5 countries, they use the rules of origin is the 35% appraised value, or don't forget the wholly of. Okay. And then what we're going to do once I get through all those slides, then we're going to go back to the other ones. All right. So where were we at? Yep, we're right here. So the other thing is I wanted to, this is kind of a summary of the difference between Israel and Jordan, Bahrain and Morocco and Oman. So, so none of them have a rule of origin provision for goods produced exclusively from originating materials. So none of them, you couldn't use that skateboard example for any of these, okay? For Israel and Jordan, the value of materials and the value of material allowance, they give you a value of material allowance of up to 15% from the other party. So remember, their rule of origin said the 35% appraised value came from the exporting party, but then they allow you to put in 15% if of the value of materials from the other party. Bahrain, Morocco, and Oman don't have that because they give you 35% from either party. And then those also have specific rules of origin. So I kind of put this in there just so you can get a better idea of the differences between the 5. And then what I did is I'm giving you just a simple calculation. This is how it looks, right? And it's simple because, you know, we're not actually putting out all we're just assuming you know what your value of materials are, right? So value of materials plus your direct cost for processing, right? Times 100 over the adjusted or the appraised value, right? So once again, that is why I went through what appraised value and transaction value means, because if you don't have, if you're not putting in buying costs or packing costs incurred by a buyer, your denominator would be wrong and you'd have the wrong outcome of an answer, right? So if the value of the materials and the direct costs for processing over the appraised value is greater than 35%, then the good qualifies and you can export and get the preferential duty rate. So this is just a summary of how a calculation would look. All right. So now we're going to go and we're going to give a tariff shift example. So now we're talking about those other countries, right? And obviously the three, Bahrain, Morocco, and Oman, have some tariff shifts, but now we're talking about the other countries, the CAFTAs, USMCA. So one of the rules of origin is a tariff shift rule. And think of this as like the substantial transformation rule. So what the foreign countries agree to, the FTA partners agree to, is that if, you know, based on HS classification, that whole flour bread or flour to bread example, if you change your product so much and you have materials or operations or labor because of that transformation, then it's going to be considered or originating in that country. So I'm going to give an example. So let's say we're exporting wine spritzers, okay? And we're making the wine spritzers with wine and fruit juice. So the rule of origin is a change to heading. So once again, this is an HS classification, a change to heading. If you don't know what heading is, that is the it's at a 4-digit level. So a change to heading 2203 through 2207 from any other heading. So if you have products 2202 and below and 2208 and above, and you bring that in and you make it into one of the 2206, then it's substantially transformed. So in this case, if wine was made from a non-FTA country, the wine spritzer would qualify because the wine is 2204, which is clearly within 2203 to 2207. So it would not qualify. And when you think about it, you know, the wine, you know, what are you doing? You're just, you know, adding something else. So you haven't substantially transformed it, right? So that's why it would not qualify. But let's say you had the fruit juice and the wine was from an FTA country, well, then it would qualify because the fruit juice is outside of that 4-digit heading. So I'm hoping everyone gets that. I'll take questions if people don't understand that, because I think it's a pretty important concept to understand, since a majority of our free trade agreements have a tariff shifts. Is there any comments, Mark? Do you see anything in the chat?
I don't see anything in the chat right now, but maybe we can open up for one question if someone doesn't understand that, because it is pretty critical. The tariff shift, that's the most common one that there is for people. So if someone doesn't get that, this would be a chance to raise your hand or open your mic for just a second and ask your question.
Are we good?
So it looks like you've got it covered.
Okay.
All right.
All right. So just, you know, because, you know, we're gonna, you know, we're just gonna go into this. So we're just gonna give you another example. So here we got a sapphire ring. So the sapphire is the HS classification from Australia. It's 7103. The platinum is from Canada and it's 7110. You can see with the rule of origin, a change of heading 7113 through 7118 from any heading outside the group. So once again, anything 7112 below and everything 7119 above would qualify. So as you can see, the good heading. So, you know, I'm using this word good. That's the product that you're qualifying for. And then material headings, right? That's your bill of materials, 7103 and 7110. They're both outside those headings, right? They're both outside. So therefore the product qualifies. So just another example. So, and once again, you bring in sapphires, you know, you bring in the platinum, you have to substantially transform that to make it a ring. So common sense says it would qualify. But don't use common sense because you'd be surprised. So always go to the rule of origin. I don't want to get myself in trouble. Okay, so the other thing, so when you have tariff shifts, a lot of the free trade agreements also have regional value content. So that is, let's say you try the tariff shift and not all your products make that shift, okay? Well, then they're still giving you an options in some, not all. I mean, some rules of origin just have tariff shift, okay? But some rules of origin also have a regional value content. Okay, and so these are the formulas for those regional value contents. And this one is the USMCA, right? US, Mexico, and Canada. And so you have something called the transactional value method. And once again, I just want to emphasize transaction value, right? So you have to go back to the original slides and what makes up a transactional value, right? So transactional value minus the value of non-originating materials times 100, and that would get you your regional value content. In the US, Mexico, and Canada, most of the transactional value method is 60%, and the net cost is 50%. And once again, when you kind of step back from this, the net cost doesn't include sales, right? Or doesn't include profits. Okay, so it's a little bit lower. So so the net cost method is regional value content, net cost, right, minus the value of non-originating materials over the net cost times 100. I will tell you, a lot of clients would, if they usually do it both ways. They try to do the calculation, and let's say for when you come out with the calculation, your transactional value method is at 75, and like I said, most of the time it has to be at 60, and then your net cost comes at 55. You're going to want to use the transactional value method because you got a little bit of a wiggle room there. But on the flip side, sometimes companies don't want to use net cost because, you know, if you get audited, then you have to share your cost information. And a lot of people, even though it's going to the foreign customers, not your foreign customer, some companies would prefer not to share that information.
Sue,
and
just
yeah, go ahead, Mark.
Just quickly, Sue, making sure you just can't pick and choose though what you want to qualify, because I've had clients say to me, oh, I won't use tariff shift, I'll use net cost or transaction value method. The rule will tell you, right, if you could actually use it or not.
Yeah, so the rules, and I don't have a screenshot of the rules, but the rules, when you go to your HS classification, or you go to the HS number, the good that's being exported, and it'll have a rule for that classification number. And sometimes it will just have a tariff shift. And then sometimes it'll have a tariff shift and a regional value content, and it'll give you an or. So you can qualify using the tariff shift, or if the tariff shift doesn't work, and obviously the tariff shift is much easier, but if the tariff shift doesn't work, then you can also qualify using a regional value content formula. Does that help, Mark?
Yes, if the rule allows it. Some people
Yep.
just want to do whatever they want. You just have to read the rule and see what the rule says.
That's absolutely correct. So then the other rules you'll see are build up methods and build down methods. Now, these are pretty much all the other ones except USMCA. And I don't know why, to be honest, why they went to this language, build up and build down. The build down method is the same for USMCA's transactional value method. And same thing, all you need to do is plug in these formulas, right, to get the regional value content. For the build up method, you're using adjusted value, which is a selling. So adjusted value, once again, that's why I was very specific on what is included in your adjusted value or your transactional value price. And then the value of the original materials used in production of the good. And then on the flip side, the build down method, it's adjusted value minus the value of non-originating materials over adjusted value times 100. And like I said, for most of them, the build up is at 35% and the build down is at 45%. And once again, the build down is a little bit higher because you're including profits. All right. So this is the other thing. If you have a, you know, you're getting your products, your materials, right? Not your good, but your materials to build your good. You're going to have a value of non-original materials. If you don't know if they qualify, then it doesn't qualify. And if your supplier doesn't know and they don't understand the free trade agreements, then it doesn't qualify. So I'm going to just give you an example here of a rule. And this is Mark, this is what you were saying. So here you got the tariff shift is A, and then B, you have a regional value content. And this is for a blender. It's a it's an actual rule for Peru, the US Peru FTA. Okay, so, just go over what we just said. So a tariff shift, you're substantially transforming the product. You're making, this is the flour to bread. And then regional value content is you're showing that, that even though you didn't make a tariff shift, that your products went through, that you had so much content, it still qualified. So in the example with, they had parts that were in 8509.90, and that is actually, I think, parts of the blender. So what they're saying, okay, it doesn't qualify because it's a part of a blender, but you did so much work, you had so much regional value content that it still qualified. So, and that's just kind of what I just said. Okay, there's another website that I kind of wanted to show you. This is really kind of cool, that the Customs Border Patrol, they have a side-by-side comparison of all the FTAs. I'm providing this link because it's just really neat. It says like what type of rules they use, whether direct shipment, and then all these other things in it. So, just want to give you that if you ever want to look at it. So now we're going to kind of dig a little bit deeper. So I've given you the basic framework for free trade agreements. You either have you have wholly of all of them, and then you have originating from the FTA partners, right? Or they become originating, right? You can use originating, and then you have tariff shift and regional value content, and then you have the 35% appraised value. So we kind of gone through all the different types of how to qualify, or all the different types of rules of origin. Now what I'd like to do is look at some generic terms that are used across all of them, and you just need to know them. So the first one will be accumulation. And so let's say you have a regional value content and you still don't qualify. Well, you can talk to your suppliers, and if their product, if their good, or I'm sorry, if their material does not qualify, but they use ingredients or products of that FTA partner, they can supply you with that cost or that value of those parts, and you can throw them into your value of originating materials. Okay. So the accumulation provision, it's in all the free trade agreements. However, they're slightly different. So if you need to use, and it's either accumulation or accumulation, if you need to use this to qualify your products, please make sure you're looking to that specific free trade agreement to get the definition and how they consider accumulation, because they're slightly different in all the free trade agreements. Then there's a chemical reaction rule, and kind of think of this as a substantial transformation, but in the chemical world. So there's a test. And so chemical companies are very aware of this. And if the test is positive, then it qualifies. Once again, very specific to that free trade agreement and that specific rule of origin. Just wanted to alert you, so if you see it, you don't think, oh, I don't know what this is. Then the de minimis provision. Now this is for tariff shifts. So let's say almost all your materials shift, but you have one, and it's something minor. And there's no regional value content. They don't give you, it's not an or. So you have a tariff shift or you don't qualify. So then they give you a de minimis option. And for the USMCA, the 10%. So you can have, if that one good doesn't, or that one material doesn't shift, it can be up to 10% of the adjusted value or total cost of the good. Once again, see that adjusted value. You need to know what that is. And then for the other free trade agreements, the non 35% appraised, they use 10% of the adjusted value. So once again, if you have one bill of material that doesn't make the shift, you can still qualify if it's less than 10% based on the denominator.
One
Okay, and
item
as
on
I
the
said-
bill of material, right? One item on the bill, one item
Yes.
on the bill of
Well, yeah,
material.
item, yes. One item on the bill of materials doesn't qualify. And you don't have a regional value content to go to. Okay, so I also want to mention that the USMS Canada has a de minimis, which is different than what I just explained. Okay, and I don't want people to confuse this. So if you're shipping something to Canada and it costs less than $500 or $150 Canadian dollars, it goes in duty free. Mexico, it's 117 US dollars. That is not the same de minimis as I just explained. This has nothing to do with free trade agreements, right? It just qualifies because it's such a small shipment. Okay, fungible goods, let's say your product needs some type of fasteners and you get your fasteners all over the world. You can either segregate them so you know that where they're coming from. So if you're making a free trade, trying to qualify, where that fastener is coming from, or you can use an inventory management, same that you would use in your accounting. So if you use LIFO or FIFO in your accounting, then you could use the same thing for when you're adding fungible goods into your bill of materials. All right, indirect materials, all FTAs except Israel and Jordan have a provision for indirect materials, and all indirect materials should be considered as originating, and the indirect materials are good use in production testing. So fuel and energy tools and dyes. So all that is considered indirect and it's all qualifying. Direct shipment. So anytime you are using an FTA, when you're exporting that good has to go directly from the United States to our FTA partner. It can't go through any other country, okay? If it goes through another country and goes into the commerce of that country, it no longer qualifies, okay? The only exception to that is, let's say you've got your goods on a ship and due to weather, they had to go to port, then that would be an exception, but it would still have to be under the control of the customs authorities. So direct shipment, very important. And they do that because a lot of countries or a lot of companies try to transship goods through other markets to claim duty preference when in fact they don't. Okay, I've already talked about the difference between materials and goods. The material is what makes up your good and the good is what you're trying to qualify. But the interesting thing is replacement parts. So a lot of times when you ship a machine, you're automatically going to include replacement parts. If you're doing that if you're shipping with the machine, then it can still qualify. However, let's say 6 months goes and your customer says, hey, I need a replacement part. Well, it then is its own good. And so, I had a client who, even though the replacement part was coming from France, was still saying it made the USMCA free trade agreement. So we had to correct that. And we had to say that, no, you no longer get duty preferential for those replacement parts. All right, so Mark, how are we doing on time?
We're doing good, Sue. We have about 5 minutes to the top of the hour.
Okay, so I want to go through this quickly, the qualification process for internal controls. So once again, I just gave you all that information. You're like, oh, now what, right? So, so qualification process, this is how you qualify. So step one, determine your accurate product tariff classification, your HS number, right? Step two, weigh the duty savings and what it costs to qualify, right? 3, look up the rules, appropriate classification. And then 4, analyze your bill of materials and production information. 5, determine if goods qualify for the free trade agreement. Then obtain the necessary valid vendor backup and records. And you have to hold them on. You have to hold on those records for 5 years. And then determine if documentation is required per the FTA. And then keep your FTA certificate and your supporting documentation, like I said, for 5 years. So this is the process you would go through. For tariff shifts, when it's just a tariff shift, it's easier, right? So assign the HS number to the product, right? So the good that you're exporting. Go to the specific product rule and look up the rules that apply. Classify your materials, your component materials. Do all the materials meet the tariff shift? Which materials must originate from the FTA country if they do not meet the tariff shift, and then just contact your vendors of any materials that do not shift to make sure. So you can't, if they don't shift, then they have to be from the FTA parties. You have to contact your vendor to make sure they are from that party. So then you look at your internal controls, right? So purchasing department. And I'm going to do this through individual departments. So require vendors to provide FTA information, notify your teams of new purchases, know the impact of sourcing on FTA qualifications, which materials do not meet tariff shift, requirements and must be purchased from an FTA country, right? So your purchasing department has to know what goods have to be from an FTA country. So then management accounting, is the bill of material reduction in price greater than the savings on the preferential duty? So let's say you can get a bill of materials much cheaper from a non-FTA partner. And, purchasing department, always wants to keep it lower, right? But, have management look at this and say, is it better to go to a non-FTA country and then not get the duty preference, right? So that has to be looked at. Inventory management, once again, if you purchase materials from FTA countries and others from non-FTA countries, are you doing the fungible rules? Do you have the segregation, right? So, your inventory people know that if they're building a product that has to qualify, they have to pull the right bill of materials, the right products to make that product. Sales. So sales need to relay the customer requests to FTA compliance department. So if they get a new FTA country, then engineering, provide details regarding product makeup, assist with classification, develop understandable product descriptions, and notify FTA compliance team of new products. IT department, and this is important, system tools to manage FTA, right? Cost of BOMs or bill of materials with vendor information, downloads of purchased products and vendor data, updates to product databases, and notification reports. Shipping, understand documents that are required, and then also quality control functions, right? So they see something that, oh, this doesn't look right, right? Maybe they see a stamp from one of the parts of the machinery that should be an FTA country and it's not. And then import and export compliance, send requests to FTA information to vendors, maintain product database, classify and analyze finished goods. And then they are the ones who complete the FTA statements if needed. So then internal controls for the regional value content. Now this is kind of interesting. So for sales prices, if a salesperson, you have to know what the lowest value is, right? So if you have a salesperson who's really looking to get a new customer, a new distributor, and they want to do a very low price, well, you have to know that, right? Because then that low price may trigger that they don't qualify under one of those regional value contents. Same thing with value of non-originating materials. We've kind of already talked about that, which materials have to be purchased from an FTA country. And the other thing that people don't think about is if your plant buys all this new capital equipment and it reduces your cost of making a product, that has to be figured in, right? If you're using net cost. So just things to think about for internal controls. So, and this is just kind of, just monitor what you're purchasing, right? So I just kind of mentioned that because, all these things, whether it's a low sales price, whether you get capital equipment, whether you get a supplier from non-FTA country that's so much cheaper, you have to make sure that people are letting that everyone's working together, because if something changes, then the product might not qualify. And that's, as I said, here's all the departments within a company that should work together to make sure that they're doing this correctly. All right, so now we're into claiming FTA preference. So when you do this, you assume responsibility for the data. So you're assuming that all the goods originate in an FTA country. They all meet the specific rule, and then you sign it. And you also know about the transition process, right? So the burden of proof. The exporter provides the importer the burden of proof, right? So if a foreign customs, they'll go to the importer because the importer is the one that's paying the lesser duty, and then the importer is going to come back to their exporter and say, hey, you need to provide supporting documentation to whatever customs to make sure that it qualifies. And as I said, you need to keep your records for 5 years. So most free trade agreements do not require a specific certificate of origin. They're just requiring you that you include the specific data elements, and that could be on an invoice. But there's a website here that once again will provide you this information, and it's done by customs, which is really nice. they have a tool where you can see, I don't know, I don't know, it's not really big on my screen, but right here in the top left-hand corner, you can pick the country of the free trade agreement, and then it automatically changes what data requirements are needed for any of our US free trade agreements. And once again, we will get you all these website links. Okay, record keeping. All these records are needed, or you need to keep them for 5 years because any foreign country, foreign government can go back 5 years. So in my case of that fabric company that was just cutting it, he got hit for 5 years. They asked for 5 years of sales data, and he had to pay the duty differential back 5 years, which was extremely expensive. So that means you need to have, you need to make sure you have some type of process if you get audited, that it's not like, oh my gosh, we have to redo this all over, right? Okay, that is it. Mark, how are we doing on time?
We're great, Sue. We're 2 minutes after the hour, so you ran through that really in a quality time, and that was a lot of information. I think everybody really learned a lot from that. This is the formal end of our lunch and learn period, but if there are questions that people have, Sue has agreed to stay around for a couple of minutes to answer them, and we'll keep them as a part of the recording. Or no, we're going to turn the recording off.
Yeah, Mark, turn off the recording now. And the other thing I would say is in this presentation that either you guys can access through the Indiana JAC or website, or if we figure out some way to send it where it won't be like 100 megabytes. I've also put in lots of different examples of each of the types of rules of origin.
Okay, we're turning the recording off now.
Okay.